Hi, everybody. This is Jason Stone with Secure Financial Planning and Wealth Management. Once again, I'm joined by Dylan Taylor, and today we're going to touch on 2025 hot button tax items as we're coming into tax season. And for those of you who are wondering, no, those tax documents are not going to be out until March 15th. So we will let you know as soon as they're ready. And for those of you that are getting those 1099s and K1s on April 14th, I'm sorry, we do not have control. We will do our best to get these things out to you as fast as we can. As they come out, we will let you know. But that's not going to stop anyone from asking. So it's a lifelong passion that we want to get our taxes done as fast as possible. But we will get you all of the information as quick as we can and make sure that we're having to limit extensions as much as possible. But the way of the world. So, with that, Dylan, what we wanted to kind of jump into today is a couple of the biggest tax breaks that clients are going to benefit from rolling into 2025 tax season. Here we go. So, biggest one, salt cap. So, how are we
hmm
looking for that for this year? What's that look like?
Yep. Yeah. Let's dive into it. Quick refresher for everyone. What is the SALT cap? It's state and local taxes, right? SALT. So the SALT cap was basically, hey, you couldn't deduct more than $10,000 of, state and local taxes that you paid. And that was what the previous cap was in 2025 and a few years prior from the TCJA. And now with the OBBBA, there's too many B's in there. I was like, it's crazy.
The big beautiful
Um,
bill.
the big beautiful bill. It's a lot easier to say when you say it that way. So the big beautiful bill um, raised the salt cap to $40,000, quadrupled it. So it went from 10,000 to $40,000 in 2026, which is huge, and probably one of the biggest changes as a result of the OBBBA.
Yeah, and that's going to apply to most homeowners in California, most of the homeowners in the Northeast, right? Higher property tax states, because what that cap really was, especially for a lot of people in Southern California and like in the big metro areas, that property tax bill alone was being using up all of that state and local tax deduction. So now you're getting that property tax deduction plus still getting right off the state taxes. So in the high tax states, right? California, New Jersey, New York, especially, then
hmm
those tax breaks are going to be pretty significant. To go from 10 to 40 is going to apply to most people that fit into that situation. The phase out starts at 500,000 of income, so it's one of the highest ones, and phases out at 600, and so anything under 500,000, you're getting that full increase in the salt cap, which is very, very big. So that's a big thing to make sure you're notching this year. We were just pontificating off recording before this about the next thing that we'd like to see is getting rid of that $750,000 mortgage interest cap, right? Because in those same high income states or high cost of living states like we have here in California, that's still where we're getting shaved pretty good on mortgage interest deduction for a lot of people. So that's probably the biggest. Another one that we were just talking about, like who is this for, was the over 65 deduction, Dylan. So talk a little bit about that one.
Yep. So there's an additional $6,000 deduction for seniors over 65 years of age, starting this year in 2026. Um, what's what's great about it too is that it actually applies on top of the standard deduction that already exists for everyone else, or everybody. So the phase out, the income phase out it starts fairly low, but it actually goes down pretty slowly as you increase in income. So if you make $75,000, then that deduction starts to um, go down. Once you hit, and that's for single individuals. For joint couples, the low range is 150,000. If you make over those amounts, then that $6,000 deduction goes down incrementally until you make over 175,000 as a single person, or you make over, I believe it's 250,000 as a joint couple.
Yep.
Um, so in any case, it's an additional deduction on top of the existing standard deduction, and it actually applies whether you take the standard deduction or you itemize deductions as
Yeah.
well. So
So
pretty
it's
nice.
almost a third standard deduction, right? That's 15,750 this year for single, and then double that for joint. So getting that extra 12,000 is a big deal. And then if you do own your place, if you're itemizing, it's still going to apply also. So now you're adding that on top of the salt cap increase, and you're talking about getting an extra $40,000 in deductions in that type of scenario, maybe a little more. So pretty crazy. Um, Maybe a little less applicable, but still another interesting one that was in here that hasn't been in here prior was the car interest deduction. That one you can write off up to $10,000 of interest on an auto loan. Similar phase outs, right? 100,000 single, 200,000 joint. But another kind of sneaky one if you bought a car this year. So something to definitely relay to your accountant because that hasn't been around for quite some time, if ever. And so it's something you need to tell them where normally you're not worried about telling them if you bought a car. Sometimes you don't want to tell them that you bought a car, right? So that's there. Dylan, how about like the overtime rules? Like what's that look like now?
Overtime rules. Yeah, I mean, there's a deduction for, if you're it's overtime and tips. That was the mantra last year and the sexy, thing everyone wanted to talk about. So,
Yeah.
I have to pull up my notes again to see what the limits are on that. I believe it was 25,000. I think it was up to 25,000 for income from tips.
From
Is
for joint. Yeah. Yeah.
Yep, yep, okay. And then is tax deductible. Um, or is it not taxable?
It's not
Actually, I should.
taxable, period.
There you go.
Yeah.
Yep. Yep.
So, not as applicable to everybody, but on the overtime side of things, right? Like for people working those, 410 shifts or things like that, where they're going to sneak in some overtime. Really nice. So that's not going to apply to everyone, but certainly for those that qualify. I mean, again, 25 grand is not bad when you're talking about making 250, 300,000 and then getting to write off that like 8-10% of your income. Um, Pretty good.
hmm
Uh,
Yeah, and just to clarify, just looking at the notes here again, it looks like income from overtime. So there's a new below the line deduction for income from overtime. It's actually 12,500 for single, and then 25,000 for joint,
right.
and then income from tips is 25,000
Okay.
as a new below the line deduction.
Thank you. And then beyond that, right, we got a little bit of bump in the child tax credits that went from 2,000 to 2,200, so that'll help a little bit. And those are credits, not deductions, so that's coming off of the money that's taxed, right? So if I owe $10,000 in taxes and I'm like Dylan and I went ahead and had that kid this year or last year, then now I get, 2,200 off that. So it's a pretty meaningful tax credit, especially when you're a new parent, right? Um, and then you've also got the same stuff. So charitable deductions for 2025 are essentially the same. We'll talk about that change for next year is going to change for this year in 2026. And then the normal IRA contributions or SEP contributions or profit share contributions that we're talking to you guys about all the time right now as we're coming into corporate tax filing. So making sure those things get done. Um, the
hmm
other thing that got brought back was bonus depreciation, right? So as a business owner, if you're taking those business equipment purchases or car purchases, that you can take the immediate accelerated depreciation and kind of write off the whole thing. I know those are big with accountants at the end of the year, but it's always one of those things of, is it better to take the deduction on 100% or to pay taxes on that, $10,000 and keep the other 8 grand in your pocket? We let the CPAs decide those things. So, uh, the other thing that we really wanted to kind of talk about in this was a little bit of stuff around the catch-up contributions and uh, backdoor Roth conversions. So this has been a pretty hot topic lately. It's something that we ask clients about a lot and around the tax changes, right, where we're getting higher write-offs and the ability to kind of lower overall income. What are the circumstances where these types of things make the most sense? So, Dhillon, let's lead off with what are the rules around the catch-up contribution now for 2026?
Catch-up contributions. So, as a quick reminder to everyone, catch-up contributions are you can you can make an additional retirement plan contribution if you're over age 50. So, I mean, I should look this up. The current contribution limit for everyone else under age 50. Let's see what it is this year. Um, I've got it right here. So 24,500 is the employee contribution limit. If you are over age 50, you can put an additional $8,000 into 401k. Um, is actually an additional catch up, ages 60 to 63, 11,250, which is interesting. Um, but here's the kicker. In previous years, you could choose to put that additional catch-up contribution into your pre-tax 401k or your Roth 401k or both. But now, this year, if you are over age 50, you want to do a catch-up contribution, but you make over 150,000, I believe it's 150,000, right?
Correct.
Um, if you make over 150,000, you don't have the option of putting that catch-up contribution into your traditional pre-tax 401k side. You actually have to put it into the Roth 401k side, which means you don't get a tax deduction this year, but it goes into that kind of tax-free bucket moving forward.
Yeah, and so the problem there is it's not usually the person making 120,000 that's doing $35,000 contributions to their 401k. I hope you are, or I hope you can. But if it's not, right, this applies most to high income clients, right? So if your income is pushing north of 300, 350,000, where we're starting to talk about these phase outs from all the other tax rules we're talking about, now you're paying tax at 24, 25% effective rate, but you're really paying in the 32, 35, 37% tax bracket. And now it's making less and less sense that I want to take this money and pay it in Roth. And again, if I'm in a high income tax state like California, not only am I paying that at the higher federal limit, I'm also paying it at the higher state limit. So you're probably getting taxed at about 40, 42 cents on the dollar or more on those catch-up contributions, where before that was a pre-tax and going completely the other way. So again, every tax situation is different. Consult your tax professional, and certainly talk to us about those things. But in general, this is not tax advice. We're talking to clients about maybe we don't do the catch-up contribution under those circumstances, and we would hold that money back in a non-retirement account. So I don't get subject to the 5-year rules. I don't get subject to having that money locked up if I'm under 59 and a half period, or I'm not going to still have access to that money for a few more years because the overall effective benefit is significantly diminished in that scenario. So something very important to look at. If you have questions, reach out to us. We can run the numbers. We can look at the tax tables. We want to loop in your accountant to talk about those things and make sure that it's in the right place and the right way. And we'll kind of take that from there. And then that bridges us into the other last hot topic, which is those backdoor Roth conversions. When you have a retirement plan, either an IRA or 401k, you have the ability to take your pre-tax dollars and convert that money into after-tax dollars. The problem or the cost of doing that is that whatever that conversion amount is, your income is getting stacked on top. So if you're making 400,000 and you do a $50,000 conversion, that last $50,000 is taxed at the higher rate above your already existing income. So where we've seen this make a lot of sense is for clients that don't need the money in retirement, or they're taking advantage of all these other tax breaks that we started with, and your income levels are very low, and we can do these conversions at the much lower tax rates. If we're doing it at 12, even 22, maybe even 24% tax break, but you don't need the money and we're going to allow this stuff to grow for 10, 15, 20 years or longer, then that's where it makes the most sense. But for another client, we just ran these numbers and we were looking at the idea of doing a $50,000 a year Roth conversion out of his 401k, right? So taking pre-tax dollars of his already pre-tax contributions in the 401k and converting to Roth. Uh, what the numbers actually came back was doing a $50,000 a year conversion for 10 years for a client that's 50 years old. So going 50 to 60 for the purposes of getting out of the 59 and a half to be able to access the money for retirement and so on. If I did 50,000 a year for 10 years, converted 500 grand, I would end up with less than $450,000 in total at an 8% rate of return. And why does that happen? Because I have so much more money going into the tax bucket, like we already mentioned, that it just doesn't actually produce any positive rate of return for the client over that decade. And yeah, now that money's tax free, but now I'm 60. And if I'm drawing that money out, I just lost, a chunk of money. And if I am going to let that money grow, how much time do I need or how much earnings do I need to make up for 10 years of no growth because I did that conversion at a higher tax rate when I'm in the 32, 35, 37% bracket? It's pretty drastic and extreme in what that thing looks like. And so it's very in vogue to talk about these things when I'm doing it in a conversion level, but for older clients or for people that are in the higher income tax levels, especially, like the answer I tell everyone is it depends, but you got to be really careful to make sure you're not doing this at a rate where you're not really even generating any benefit at all, except to the government. And if you do, hey, right on, but it's not what we're trying to accomplish for you guys, right? So, Dylan, anything to add on to that?
What if you're just like so charitable and you just want to send all your money to the government?
The
I
government
mean,
appreciates your service, right? Thank you for your service, but I don't know if any of you guys out there are fitting that bucket. Not right now, right?
right, right. Yeah, the government accepts tips. If you guys want, you can
True.
absolutely send more to the government. But all jokes aside, I think, Roth conversions are a hot button topic that you're going to see articles, popping up on your feed. I mean, if you're in the financial sphere, ingesting any financial information or news or education, Roth conversions are a really sexy thing to talk about. But the reality is they don't pay off for a lot of people during what you would consider like the heyday of your retirement years, when you're spending and trying to enjoy your retirement. Roth conversions take a long time to pay off, which can benefit the person who's doing the Roth conversions themselves, but it's kind of a long years way out. But what I like to mention to people, it really benefits your heirs significantly because you have so much more time. You converted money from pre-tax to a Roth, tax-free growth in that Roth, and eventually, that tax-free money is going to compound and grow and grow and grow. And if you pass away with a large amount in that Roth bucket, well, that's tax-free to your heirs. So, and if they can keep it in that bucket for a little bit longer, that's that. You're seeing some pretty significant tax savings. But just to be very real with people, that being said, Roth conversions can make a lot of sense for people, um, very strategically. And we talked about this, before we started this video. But for someone who's retiring and it's between when their salary stops and when they start Social Security, maybe there's not a lot of income coming in. For a lot of people who don't have pensions, there's no pension coming in, no Social Security coming in. So the only income they would have is what they're pulling out from their portfolio. And in those years, your income is extremely low. And that could be a really good time to be doing Roth conversions. When you're in the 12% tax bracket, I mean, you don't have much income anyways. You could be, filling up the 12, 22, 24, depending on how much money you have in the pre-tax accounts. It can make sense to do that. Um, and then I also want to go back to something you were talking about with the mega backdoor, 401k contributions.
Yep.
So one strategy that is possible for people that does make a lot of sense is if you have a 401k into which you can make after tax contributions. Basically, you make a contribution into a bucket. So there's basically, I'll just break it down, just three different buckets. There's the pre-tax bucket, the traditional 401k that everyone knows about, the after-tax bucket, which is it's not deductible to you. Um, uh, but it's not in a tax-free bucket like the Roth. And the third leg is the tax-free bucket, the Roth bucket. So what sometimes people can do is they can max out their, employee contribution limit of now this year it's 24,500 between, pre-tax and Roth. And if the 401k plan allows, you can put money into an after-tax bucket and then convert it to the Roth 401k option. And the income limit on, or the actual cap on that, I believe this year is 72,000.
Right around
When
there.
you add up your employee contribution limit plus the employer match plus what you can put in after tax, um, if you can convert that after tax money to Roth, I mean, you're getting just a lot more money into the Roth bucket. And this really only makes sense if you have plenty of money outside of retirement already, because you're dumping at this point a lot of money into your retirement plans.
Yep.
Um, but that I think when people say, "Hey, I'm interested in the mega backdoor Roth strategy," that's I think what most people are talking about. Um, and unfortunately, most people don't have access to doing this strategy. But if you do, I actually had a client last year who's doing this. Um, it can be pretty powerful to get more tax-free money going.
But again, the answer is always it depends. So we want to look at it, we want to run those
Yes.
numbers because if you're sinking $70,000 into your 401k plan because you can, you got to factor in the employer contributions. You're putting in that extra money. And if you're putting in that much, I'm guessing you're in the higher income limits already. So also still keep in mind, you're still paying that higher tax on the front end. You're not just getting this for free because it is a non-deductible bucket. So I mean, if it's already in there, it's already sunk cost, right? So then that makes 100% sense that I want to do this backdoor conversion. But even if I'm putting that money in the non-deductible bucket, I'm definitely paying that higher tax bracket in most cases, right? So
Certainly.
uh, we
Certainly.
want to
Yeah.
be careful of those things all the time. So as always, consult your tax advisor. We can't say that enough. But making sure that we're all coordinating together and working and pulling in the same direction is one of the things that's so important about financial planning. So um,
Yeah. Well, and one just a real quick mention is if you're in a high income tax bracket and you're putting money in the 401k, like if we're trying to get as much deductions as we can and reduce our income now, you're just going to max out the employee contribution amount, 24,500 in the pre-tax bucket. And that's the best you can do. I mean, if you're a high income earner,
yeah,
you know, and then the decision that you have from there is, do I want to put money into a non-retirement bucket, or do I want to put more money in my 401k in the tax-free bucket if possible, um, by doing this other strategy, or catch-up contributions or whatever. And that really just comes down to, when am I going to retire? When do I need to access my retirement plan, my 401k? um, if I'm going to be over 60, when I do, maybe it is good to put in the Roth side of things. But if you're going to be under that and you need access to funds, maybe the non-retirement bucket is better. So just wanted to put a cap on that so everyone got that.
sure. And then the opposite end of the spectrum, right? For our kids or for new people in the workforce, right? So when we're talking to clients' kids, uh, Roth makes tons of sense, right? If I'm sitting in that like 100,000 a year income or $80,000 a year income or lower, and I can put the money into a Roth IRA or into Roth 401k, now I can get Roth 401k match that didn't used to be available to, right? Those things make tons of sense. And the difference there is just time, right? If I've got 50 years to let this stuff compound, it's going to be better because I'm doing this at the lower tax bracket at 10, 12, 15% effective rate compared to doing it at the 32, 35, 37. So it's very circumstantial, right? You have to make sure that you understand the rules because you don't want to put yourself in a worse place just because you want to do this trendy thing, right? That's talked about on my Instagram feed. So let's make sure we're making good, smart decisions with our money as always. And Dylan, any other closing comments?
No, I don't think so. Happy tax planning, everybody. Good luck this year with your 2025 returns.
And
And
and we
yeah,
promise we will get the tax docs out to you as soon as we can. As soon as we know, we will get them to you. I promise. All right. Thanks, everybody. Till next time. Thanks, Dylan.
yep.